Imagine a highly successful local grocery chain outgrowing its home neighborhood to aggressively target the entire surrounding region. That's the exact transition Patel Retail is attempting right now. It's mid-June 2026. The stock is trading near 217 rupees, and they just posted blockbuster full-year numbers. On the left, 54% profit growth and 1,000 crores in revenue. But on the right, fourth quarter margins dropped to 6.7%, with spiking capital expenditure and export receivables. Is this building a compounding machine or masking a cash flow crunch? Indian retail history is littered with cautionary tales. Look at Kishore Biani and the Future Group empire. Scale doesn't guarantee survival in this sector. In fact, trying to grow too fast is exactly what usually kills retail giants. To protect yourself, you need a reality check. Instead of blindly trusting a low PE ratio, we're going to run a forensic filter, focusing on debt, working capital, and earnings quality. Deciding if 217 rupees is a deep value opportunity or a trap requires looking past the reported profit line. We need to find out if the actual cash exists to fund that 75-store ambition. This is our forensic scorecard. We'll use it to evaluate Patel Retail's true financial health across a few critical dimensions. First up is the business model. Patel Retail operates as a retail-export hybrid. While they push higher-margin private labels in their own stores, 48% of their manufacturing revenue actually comes from exporting processed foods to 35 countries. That export wing provides a solid 5 to 10% margin boost over selling other people's brands. But it introduces serious risks. You're suddenly exposing a local retail operation to unpredictable Middle East geopolitics and sudden shifts in government export policies. Next is valuation. The stock trades at a price-to-earnings ratio of around 16.7, which looks incredibly cheap placed next to their 54% profit growth. This breaks down the PEG ratio, price earnings to growth. By dividing the 16.7 PE by the 54% growth rate, we get a PEG ratio of roughly 0.30. In traditional valuation frameworks, anything below 1.0 is considered cheap. A 0.30 PEG places the stock squarely in deep value territory. But deep value only stays valuable if management actually delivers their projected 20% growth in the coming year. If same-store sales slow down as they open new locations, that low PEG ratio quickly turns into a value trap. This bar chart shows Patel Retail's debt-to-equity ratio. You can see a steep drop from 1.34 down to 0.34, fueled almost entirely by the recent IPO proceeds. While the overall interest burden is much lower, they still carry about 160 crores in short-term debt. That debt is tied directly to working capital, meaning it could spike rapidly as they stock up inventory for their new store rollout. Inside the stores, the operations are tight. They run an excellent 12x inventory turnover rate, which means they are highly efficient at moving physical goods off these shelves and into customers' hands. However, the export side of the business creates a drag. Shipping goods overseas stretches out their debtor days. Cash gets trapped in international market receivables, slowing down what would otherwise be a lightning-fast retail cash cycle. To see if this slowdown is dangerous, we use the CFO to PAT ratio shown here. You divide cash flow from operations by profit after tax to check if the reported profits actually showed up in the bank account. Right now, Patel Retail looks like a classic Trap 3 scenario in this framework. Their cash is temporarily being consumed to fill new store inventory, a normal friction of high growth, rather than a malicious accounting illusion. You have to watch this metric closely over the next few quarters. If the CFO to PAT ratio stays below 0.5 for 3 consecutive years, it stops being growth friction and becomes a structural cash trap. Until now, Patel Retail has operated primarily as a hyper-local player, deeply concentrated within the dense urban clusters of the Mumbai metropolitan region. But their new CapEx plan is aggressive. They are pushing out of their comfort zone, targeting Pune and the Tier 2 outskirts, aiming to scale from 51 to over 75 stores by the end of fiscal 2027. This line chart tracks their EBITDA margins over fiscal year 2026, and it reveals the immediate pain of that expansion. Margins fell to 6.7% in the fourth quarter, under the weight of heavy initial setup costs for the new locations. When you pour cash into physical store build-outs before those stores reach peak sales volume, your return on capital employed and return on equity take an immediate, unavoidable hit. Rapid physical scaling mathematically depresses short-term profitability ratios. For the math to work out, management has to flawlessly execute same-store sales growth in these new territories to recover their margins. So we are left looking at two competing realities. You have incredibly strong fundamentals, a 70% promoter holding, a freshly cleaned balance sheet with a 0.34 debt-to-equity ratio, and rapid inventory turns, fighting against the heavy margin pressure of a 75-store expansion. To figure out if you should buy, let's look at this decision matrix. Mapping investment horizon against risk tolerance places Patel Retail firmly in the long-term, medium to high-risk quadrant. If you have a 3 to 5 year horizon and want to lock in a 0.30 PEG ratio, this is a cautious accumulate. But you have to be willing to stomach severe margin pressure and ugly quarterly headlines for the next few quarters while the new stores stabilize. On the other hand, if you're a momentum trader looking for an immediate jump in capital return ratios, this is a clear avoid. The operating cash flow will remain highly volatile during this heavy expansion phase. Your immediate homework is simple. When the next annual cash flow statement drops, go straight to Section A, find the cash from operations, and manually divide it by the profit after tax. In the retail business, profit numbers are written on paper, but territorial expansion is paid for in hard cash. Your job as an investor is to make sure that cash actually arrives.